Welcome back to the deep dive. Today we are really cracking open a topic that's crucial if you're selling a big asset. Think real estate, business assets, that kind of thing.
Right, anything where you don't get all the cash up front.
Exactly. We're doing a deep dive into installment sales. We'll be looking closely at IRS Form 6252 and Publication 537 for the details.
Yeah, the official guidance.
Okay, so let's just start with the basics. What is an installment sale officially?
Simple definition.
Yeah.
It's just a sale of property where you get at least one payment after the tax year the sale actually happens.
Sounds straightforward. And, it seems like a great deal tax-wise because you defer the gain, right? You pay tax as the money comes in.
It does sound great, but here's the catch you really need to grasp. It's not usually an option. If you have a gain, the installment method is typically mandatory.
Mandatory, so you have to use it.
Generally, yes, unless you make a specific choice, an election, to not use it. So our mission today isn't just about, delaying payments. It's about understanding the rules, sometimes pretty tough rules about what the IRS considers income and when they consider it income. Sometimes even when you haven't seen the cash.
Right, those deemed payments we hear about. And before we get into the math, let's quickly cover what doesn't qualify. There are exclusions.
Definitely.
Yeah.
Big ones. You can't use the installment method if you have a loss on the sale. Losses get reported right away.
Makes sense. What else?
No installment method for selling inventory or for sales by regular dealers in property.
Dealers. Like a car dealer selling cars.
Kind of, but think more real estate developers selling lots constantly. Though there are special rules for things like timeshares and residential lots involving interest payments. Bit niche, though.
Okay, and the really big one?
Stocks and securities. If they're traded on an established market, forget the installment method. Sell stock, pay the tax now.
Got it. So basically, if it's easy to sell for cash quickly, the IRS wants the tax quickly, too.
That seems to be the thinking. But for other stuff, like that building or piece of land, we move to the main point. How do you report just part of the gain with each payment?
Right. So, okay, the buyer sends you a payment, not counting the initial note, obviously. That payment isn't all taxable gain, is it?
No, not at all. Each payment you receive, apart from any interest, is actually made up of three distinct parts.
3 parts. Okay.
First, there's the interest income. That's stated in the note usually, taxed as ordinary income.
Standard.
Second, you get back a piece of your investment tax-free. That's the return of your adjusted basis in the property.
Okay, tax-free recovery. Good.
And third, the rest of it. That's your taxable gain. That's the installment sale income you report for that year.
So the trick is figuring out how much of each payment falls into bucket 2 versus bucket 3.
Exactly. And for that, we need the absolute core calculation, the gross profit percentage, the GPP.
GPT. Okay, sounds important.
It is. Think of it like a fixed ratio. It tells you what percentage of every single principal payment you receive is actually taxable gain.
And how do we calculate this? GPP.
You need two numbers. First, your gross profit. That's your selling price minus your adjusted basis for the sale.
Selling price minus basis. Got it.
Then you need the contract price. The gross profit divided by the contract price gives you your GPT.
Okay. Let's walk through an example. The source material had a simple one.
Yeah, let's use that. Say the contract price is $6,000, and let's say your gross profit is $1,500.
Okay.
Divide $1,500 by $6,000. That gives you 0.25 or 25%.
So the GPP is 25%.
Right. Now, let's say the buyer makes a principal payment of $1,000 this year.
Okay.
You take that $1,000 payment, multiply it by your 25% GPP. That's $250. That $250 is your taxable installment sale income for the year.
And the other $750 of that $1,000 payment.
That's your tax-free return of basis.
Okay.
Yeah.
That makes sense. So that 25% applies to every principal payment going forward.
Generally, yes. It stays the same.
Yeah.
Unless
There's always an unless with taxes. What changes it?
the most common one is if the selling price itself changes later on. Maybe you renegotiate the note, reduce the price because the buyer's having trouble.
I guess the price goes down.
If the selling price is reduced, your total gross profit on the deal goes down too. So you have to recalculate the GPP.
A new GPP.
Yep. You figure out the remaining basis, the remaining profit, and calculate a new GPP that applies only to the payments from that point forward.
Right. You don't go back and change prior years. You just adjust for the future.
Correct. You spread the remaining gain over the remaining payments.
Okay. That seems logical. But now let's get into the maybe less logical parts.
Right.
Where the IRS says you got paid even if you didn't see cash. Deemed payments.
Yes, this is where it gets tricky. A really common scenario involves existing debt on the property, like a mortgage.
Okay, so I sell a property, it has a mortgage, and the buyer agrees to take over the payments.
Right. Now, if that mortgage the buyer assumes is less than or equal to your adjusted basis in the property,
My basis. Okay.
then the IRS says, okay, that's fine. It's not treated as a payment to you in the year of sale. It just reduces the contract price used in the GPP calculation. It's sort of a wash against your basis.
So debt assumed up to my basis doesn't trigger immediate tax. Good to know. But what if the debt is more than my basis?
Ah, now you've hit the tripwire. This happens a lot with properties held a long time, maybe depreciated heavily or highly leveraged.
So the mortgage the buyer takes over is bigger than my remaining investment, my basis.
If that happens, the excess amount, the difference between the debt assumed and your basis, is treated as a payment received by you, right there, in the year of sale.
Ouch. So immediate tax on that phantom income.
Immediate tax.
Yeah.
And it gets worse.
Worse. How?
If you cross that line, if assumed debt exceeds basis, your gross profit percentage for all future actual cash payments becomes 100%.
Wait, say that again. 100%.
100%. If the assumed debt pays off your entire basis and then some, the IRS figures you've already gotten all your investment back and more through debt relief.
So every single dollar of principal the buyer pays me from then on is pure taxable gain. No more return of basis portion.
None. Zero. Because you already recovered it via the debt relief, that 100% GPP is a huge consequence. It dramatically changes the cash flow reality of the deal versus the tax reality.
Wow. Okay, that's a major heads up for anyone selling leveraged property. What about smaller things? Like if the buyer pays my real estate agent's commission?
Also counts as a payment. If the buyer agrees to pay any of your selling expenses commissions, legal fees for the sale, transfer taxes, anything that's your liability, the amount they pay, is treated as a payment to you in the year of sale.
Because they settled your debt.
Okay.
Deemed payment.
Exactly. It's an economic benefit you received.
Okay. Now, staying on this theme of accelerating the tax, there's something called the pledge rule. Sounds ominous.
It can be. This applies mainly to larger sales specifically, sales where the property selling price is over $150,000.
Okay, so not for small stuff,
Okay.
but over $150K.
And it doesn't apply to selling your personal home or generally farm property.
Right.
But for business assets, investment property over $150K. If you take that installment note the buyer gave you,
The promise to pay.
right, and you use that note as collateral, as security, to get a loan yourself from a bank, say.
Okay, so I'm borrowing against the buyer's future payments, getting cash now.
The moment you do that, the net proceeds you get from that loan, the cash the bank gives you, are treated as if they were a payment received on the original installment sale.
Whoa. So pledging the note basically cancels out the tax deferral up to the amount I borrowed.
That's precisely the point. The IRS says, look, you wanted cash now, you got cash now by borrowing against the note. So you pay the tax now. It stops you from getting liquid without triggering the tax.
Okay, another acceleration trap. Let's shift to segment 3. This is where things get even more targeted, right? Depreciation recapture and deals with family.
Absolutely. Let's start with depreciation recapture. This is huge. If you're selling property, you've depreciated like a rental building, business equipment.
Stuff where you took depreciation deductions over the years.
Right. The rule here is brutal. All that depreciation you have to recapture is ordinary income. You report all of it in the year of the sale, period.
All of it, even if I receive 0 cash payments that year.
Even if you receive nothing. The installment method deferral does not apply to the recapture part of the gain.
So the gain gets split. Recapture first, then the rest.
Exactly. You calculate your total gain, figure out how much is depreciation recapture. You pay tax on the recapture amount immediately in year 1. Only the gain above the recapture amount qualifies for the installment method treatment using the GPP.
Why do they do that? Seems harsh.
Well, the thinking is those depreciation deductions you took in prior years reduced your ordinary income then. So when you sell, the IRS wants that ordinary income benefit paid back immediately, not deferred.
Okay, forces a mismatch. Potential big tax bill in year 1, even with little cash flow. Something to plan for.
Definitely. Now let's talk related parties. This is probably the most well-known anti-abuse rule area.
Yeah, selling to family to spread out gain. Who counts as related here?
It's a specific list. Your spouse, your kids, grandkids, parents, brothers, and sisters. Also includes certain controlled corporations or partnerships.
So close family and controlled entities. What's the rule trying to stop?
It's trying to stop you selling, say, land to your son on a 20-year installment note. He pays you a tiny bit each year, but then he turns around and sells it immediately to an outsider for full cash.
Ah, so the family unit gets the cash now, but the tax is deferred way out on the original sale.
Exactly. So they have the 2-year look-back rule.
The 2-year rule. Okay, how does that work?
If you sell property, the first disposition, to a related person on an installment plan.
Me selling to my son, for example.
Right. And then that related person, your son, sells the property again, the second disposition, within 2 years of your sale to him.
So he resells it quickly.
Then you, the original seller, generally have to accelerate your gain. You have to treat the amount your son received on that second sale as if you received it directly at that time.
Oof. So if my son resells the land 6 months later for $100,000 cash, I basically have to pretend I received $100,000, even though he's still just paying me according to our original slow note.
Pretty much. You calculate your remaining gain, and you recognize it up to the amount your son received on his resale. It effectively wipes out your deferral benefit because the family got the cash.
That 2-year window is key then.
It is for most property.
Yeah.
For marketable securities, there's no time limit at all.
Okay. Are there ways out of this related party resale trap? Exceptions?
Yes, a few important ones. It doesn't apply if the second sale happens because of something involuntary, like a creditor forces the sale or bankruptcy.
Okay, involuntary events.
Also doesn't apply if the second sale happens after the death of either you, the original seller, or the related person buyer.
Makes sense. Death changes things.
And there's a general exception if you can convince the IRS that neither sale had tax avoidance as a principal purpose. That's a high bar to clear, though.
I bet. Now, wasn't there something even stricter for selling depreciable property to related parties?
Oh, yes. If you sell property that could be depreciated by the related buyer, think selling a business building to a corporation you control.
Okay.
In that situation, you generally cannot use the installment method at all. All payments are treated as received in the year of sale. Full gain recognized immediately.
Wow. No deferral whatsoever for depreciable property to certain related buyers.
Correct. Unless, again, you can prove no tax avoidance motive.
Yeah.
But the default is no installment method allowed. It's a very strong anti-abuse rule.
Okay. So after hearing all these pitfalls, acceleration rules, maybe a listener just wants out. They don't want the hassle. Can they just choose to pay all the tax up front?
Absolutely. You can elect out of the installment method.
How do you do that? Is it complicated?
No, it's actually about not doing something. You simply report the entire gain in the year of the sale on the normal forms you'd use, like Schedule D, Form 4797, or Form 8949.
So you report it like a regular sale?
Exactly. And crucially, you do not file Form 6252, the installment sale form. You just report the full gain and pay the tax.
When do you have to decide?
You have to make that election by the due date of your tax return for the year of the sale, including any extensions you get.
Okay, so you have some time to think, run the numbers. Seems like a good option if you foresee issues like needing to pledge the note or if the related party rules might bite you.
Or if you just want the certainty of getting the tax paid and being done with it.
Right. Now, one last piece of complexity, and this one's really for the big players. Interest on deferred tax.
Yeah, this rule doesn't hit most people. It kicks in only under 2 conditions, and both have to be met.
Okay, what are they?
First, the property sold has to have a sales price over $150,000.
Same threshold as the pledge rule trigger.
Right. And second, the total face amount of all your outstanding non-dealer installment obligations from all sales like this has to exceed $5 million at the end of the tax year.
$5 million in outstanding installment notes. Okay, yeah, that's a high bar.
It really is. It's aimed at people doing very large deals or multiple large deals where the deferred tax liability becomes substantial.
So if you cross both those lines, over $150K sale price, A&D, over $5 million in total outstanding notes, what happens?
You have to pay the government interest on the tax you've deferred.
Interest on the deferred tax. So you're paying them for the privilege of waiting to pay.
Essentially, yes. It's like the government is charging you for the loan you're effectively getting by deferring the tax payment.
How complex is calculating that interest?
It's not simple. You have to figure out the amount of unrecognized gain tied to the obligations over the $5 million threshold. Then you apply the maximum tax rate to that gain to get the deferred tax liability. Then you multiply that by the current IRS underpayment interest rate.
Okay, yeah, definitely something you'd want your accountant handling. And is that interest deductible, like regular investment interest?
Good question. And the answer for individuals is a clear no.
Not deductible.
Not deductible.
Right.
It's treated as an additional tax liability on your return, just an extra cost associated with having very large amounts of tax deferred via installment sales.
So it eats directly into the benefit of the deferral for those large-scale sellers.
It does. It makes the deferral less valuable the bigger it gets past that $5 million mark.
Okay, let's try to wrap this all up. We started with what seems like a simple idea. Sell now, pay tax later as you get the cash.
Simple concept, yeah.
But the reality is, well, it's layered with rules designed to accelerate that tax payment, isn't it? Depreciation recapture hits you immediately.
Right. Year one.
Debt assumed over basis. Boom. Immediate payment and 100% GPP later.
A big trap.
Selling to related parties who resell quickly, your deferral vanishes.
The 2-year rule, yeah.
Pledging the note for cash. Same result. Tax comes due.
The IRS sees you got liquid.
So the key takeaway seems to be, yes, installment sales offer deferral, tracked on Form 6252 year after year.
And you must file that 6252 every single year. The obligation is outstanding,
Yeah, right.
even if you didn't receive a payment that year. Keep track.
Right, but approach it with eyes wide open. Understand these acceleration triggers.
Absolutely. The deferral is real, but it's conditional. The IRS has built-in mechanisms to pull that tax forward if they think you've realized the economic benefit sooner.
Which leads to a final thought to leave everyone with. Given how many ways there are to trigger early tax recognition, especially that immediate hit for depreciation recapture or the 100% gain on excess debt, how much of that initial deferral benefit is actually real for complex sales?
It really forces you to model it out, doesn't it?
Yeah.
Compare the installment method with all its potential traps and annual filing requirements versus just electing out, paying the tax, and moving on. Sometimes simpler is better.
Something to definitely crunch the numbers on. Thanks for breaking down that complexity with us.
Glad to do it. It's important stuff.
Indeed. Until next time for our listeners, keep digging, keep questioning,